Hey everybody, welcome to the morning market briefing, Monday, March 28th, 2022. Hope you're doing well. Hope you had a good weekend. Tom, Will Smith, real slap, fake slap?
I think it was real. I think he's a noted alien and weird person. I think there's been plenty of evidence that Will Smith is a very bizarre human being, and so taunting him in a public forum is probably not a good idea.
I tend to agree, Ben. We talked about it earlier. For those that missed it, Will Smith slapped Chris Rock and finally gave us something somewhat exciting at the Oscars. First time I feel like the Oscars have been interesting since they announced their own winner for best film. Ben, thoughts?
Yeah, I think it was legitimate. I think it was, it's crazy. I did not think I'd be talking about the Oscars today because I also thought they were in February. So I guess I'm not the Hollywood expert.
Yeah, for some reason, Amanda and I, we always kind of watch it for we don't see any of these movies. I mean, they're all, I guess, just more artistic than we are, and we have kids, so we watch a lot of kids' movies. And we watch them almost to be like, oh, I mean, I really, you could definitely play two truths and a lie, like which of these was a real movie that came out in 2021 and which was not, and I would do very poorly at that. But we of course went to bed before that actually happened. So what can you do about it? Russia, Ukraine. We're done with our commentary on Hollywood. Biden kind of going off script, saying that Putin cannot remain in power. Lots of stories over the weekend, lots of social media feeds of action in different ways. Ben, give us a high-level overview on where things stand 48 hours later.
Yeah, I mean, I think that fortunately, or maybe on purpose, Biden timed those comments when Russia's been struggling, was already beginning to pull back into Belarus and get a little bit more on supplies, especially in the Northeast, and really try to solidify around the South and create that land bridge from Crimea to the area in the Donbas region, because it was a very poorly constructed comment from Biden, and also fell on the heels of him talking about last week, saying that when he was talking to the 82nd Airborne Division in Poland, he says, you're going to see when you're there. And then he continues, which implied to many people that they would be on the ground in Ukraine. And obviously has not been the case. And White House was very quick to backtrack on that. But there's been a lot of backtracking by the White House. I think part of this is the pressure of the polls. Biden's polling at the lowest levels that he's ever polled at. And it's certainly, these comments won't do any good. A lot of allies are actually coming and saying, hey, these comments were misguided. Emmanuel Macron, who seems to think he's friends with Putin for some reason, he said, I wouldn't use this type of wording because I continue to hold discussions with President Putin. I think it is significant, though, because you're not seeing the Kremlin get agitated about this to the extent that they might have otherwise. I think if this was 2 or 3 weeks ago, you could have seen the Kremlin really become antagonistic about it, but you haven't really seen the dramatic response that I might have expected from the Kremlin. So I think that's significant, and it kind of tells you all you need to know and how the war's going from a Russian point of view.
Yeah, I think that's an appropriate view on it. I think we're starting to really start to see some of the war fatigue set in from media coverage. It seems like it's certainly been, at least from my view, lightening up a little bit. No major developments over the weekend. For what it's worth, markets are slightly up, but essentially as flat as you can be. Dow futures are up 1 point. S&P futures are up just a smidge. 4 basis points, basically. NASDAQ futures up 9 basis points. We're basically looking at a flat day, kind of a nice reset perhaps to start the week, kind of see where the markets want to go. We do have a lot of economic data, other things coming through the pipeline that we'll touch on later. But the next story we want to hit is Barclays. Big issue here is they sold more securities than they had registered to sell. I don't know if Tom wants to jump in on this because it is on fixed income world. Explain kind of what happened and why it matters and what the impact will be, because it seems like a pretty obvious administrative lack of oversight.
Yeah, basically what happened is a lot of these banks get pre-approval for how many of these structured notes they can issue. And a structured note is essentially a bond that's linked to, it can be a steepener, meaning it's based on interest rates, or it could be exchange traded note, which means it's based on some sort of underlying index. So oil prices and volatility markers are the ones that these notes in question were attached to. And you can basically say, hey, we've got approval to sell up to X amount of these bonds. And then we need to come back for more approval. And the reason they do that is to ease, sort of the regulatory environment, which means that, hey, you can do up to this point. Once you get there, come back and see us and we'll give you more approval. And so Barclays issued about $35 billion in exchange traded notes related to the oil markets and to the VIX, and they were only approved for 20.8 billion. And so now what they've got to do is turn around and buy back those bonds, which means they've got to use that money. Plus they've got to, essentially buy them back at the price that they originally issued at, and they've got to eat all of the sales charges. And when you issue these notes, the reason they're so valuable to banks is because they can make massive sales charges on the front end. It's a highly litigious area of the bond market. There used to be a firm in Buckhead called JP Turner, which sounds made up. It sounds like they're just trying to sound like JP Morgan, and I think they were. But they went down, like the whole firm. I mean, they used to be, one of the best financial firms to work for. Everybody went to work there. I had a couple buddies who worked on some desks over there. And then one day the firm got bought. And then like 3 months later, it turns out the company buying them made a big mistake because they went under because of massive regulatory problems associated with structured notes. So this is an area that's got a lot of eyeballs. And of course, you don't want to be crossing the line in an area where there are a lot of regulatory eyeballs. And that's what Barclay has done. So they're going to eat all the sales charges, going to cost them a bunch of money. And they've got to find a way to raise the capital to buy back all these bonds. And of course, the people who bought them are going to be mad because if they're related to oil prices and volatility, they're probably way up. And so, you think you bought this bond, it's gone through the moon, because oil prices have gone up, and then you're going to get the money back that you spent on it. So it's not a great look for Barclays. European banks have been in the toilet for pretty much my entire career. I imagine they look even more relatively valuable now, but they keep stepping in it. Barclays, Deutsche, Societe Generale back in 2009, 2010. So, just another misstep for a European bank, which is not unexpected, I would say.
Yeah, it's weird. The craziest thing to me is that it kind of took this long for this to be uncovered. It happened in 2019. It seems like, given the surveillance software and all the things that regulators use, it seems like it would be fairly obvious right off the bat that they sold more securities than they were registered for. So kind of an odd story on that level. It's going to cost Barclays about $700 million US to rectify the issue. So we'll kind of keep an eye and see if there's any additional fallout from that. We've talked a little bit on the show about obviously inflation, but specifically about inflation and potential impacts on demand, especially as we see things like gas prices remaining relatively elevated. And Apple is now saying they're cutting their iPhone production, specifically on iPhone SEs, and citing signs that consumer electronics demand is being hurt by the war in Ukraine and rising inflation. Ben, what's your takeaway on this? And are you surprised to see, in a way, it seems like a relatively early period to hear that announcement?
Yeah, it does seem very early considering that the iPhone SE was only launched a couple of weeks ago. My opinion on this is that Apple's continuing to sell more of the higher end iPhones. So that's number one. Number two is you're lowering production orders by about 2 million to 3 million units, which sounds like a lot, but it's in the context of Apple selling about 220 to 230 million iPhones a year, many of which are the higher margin iPhone 13s versus the iPhone SE. So I think that's important to bear in mind. I think the information reported out of Nikkei, which is a news agency in Japan, there's a lot of news that comes out of Nikkei, and some of it's accurate and some of it's a little bit misleading. So I have that context in my mind, and I don't know how much is being editorialized by saying that they are being impacted by the war in Ukraine and by inflation. I think certainly that may be true in Russia and Ukraine, But globally, I don't know how much of an impact that is having. We're not seeing it in the other data, but it is interesting to see. I would take more note of it if Apple came out and actually said something about that. But right now, if they're just cutting a few orders at the margin on a new lower end product, I'm careful to read too much into that. It's one data point, and we got to look out for more data points. But for now, it's just one data point, and a small one at that.
Yeah, it makes sense. I think when you think of the overall scale of the iPhone market, it probably makes sense, and you could see lessening demand. It also makes sense that those going after a lower model of the iPhone might be those also most impacted by gas prices, et cetera. Tesla, meanwhile, is going to ask shareholders for more shares as it's trying to lead up to another stock split. Ben, it seems like this would go through. What components come into play when you have a company like Tesla, especially one that is somewhat aspirational in its mission and what it wants to achieve? How likely are shareholders to push back or even fight this?
I think shareholders are going to go along with it. You have Elon Musk, who has so much of controlling interest in the company. The question is, does it actually have much of an impact? The stock's actually trading up 6% this morning. And I think that's a little bit phony. You saw Amazon and Google trade up when they announced a stock split, but that's because they need to get the price down of their shares in order to get added to the Dow Jones Industrial Average, which is price weighted. Tesla's not going to be added to the Dow. So the question is, does this really increase the demand for the shares? Even if they were to do a 10-to-1 stock split and the price drops from $1,000 to $100 a share, you're not really, if people can't afford one share of Tesla at $1,000, it's not really like that demand for one share of Tesla at $100 is really going to increase the price of the stock all that much. So I think the 6% move is a little bit overdone pre-market. Having said that, I think that because Tesla doesn't really trade on fundamentals right now, you could see this price stick, but it's not a good reason to buy the stock, especially now. I mean, even with the Amazon and Google, you could make an argument that the incremental demand from being part of the Dow is going to result in more demand for the stock and a higher stock price. But with Tesla, I just don't see the rationale. They've done this in the past. And I expect more volatility with Tesla, both up and down. And that's what I have to say about that.
Good deal. Relatively busy week in terms of economic data. I think Ben makes a good point on we need to keep looking at anecdotal evidence, but we need to be looking for trends of things that are to come. Certainly end the quarter on Thursday, that will be a big period of managers tightening allocations. Not talking so much here. We try to be on top of that all the time, but there are certainly going to be large institutional players that want to end the quarter in the position that they're supposed to be in based on their mandate. So I would expect potentially some buying up throughout the week as we come towards that Thursday close. Ben, what else are you keeping an eye on?
Yeah, that's the big one that I'm going to keep an eye on. I think that we've already seen, I mean, the market's only down 4% for the year right now. We're up significantly since Russia invaded Ukraine. And my view is you're probably having a lot of fund managers, mutual funds, RIAs who were not as active in keeping allocations correct earlier on and are now chasing. And I think that's some of the buying that you've seen because, clients, especially of mutual funds or wherever, will play Monday morning quarterback and say, you didn't stay disciplined in February and early March. And why weren't you keeping that allocation straight? And so they're going to try to make it right by the end of the quarter. And that means you have more buying. And we may have already seen that. So I also wouldn't be surprised to see a little bit of a pullback here over the next week as that buying already took place last week. Having said that, you never know what's going to happen at the end of the quarter, and you can always see a quarter end markup as well. Big thing on Friday is going to be the unemployment rate that comes out at 8:30. We also get the ISM manufacturing, which is going to be a month of March number. That'll come out at 10 a.m. So it'll be after the call, but that'll be really interesting to watch because we get a lot of commentary about what manufacturers are seeing. We're seeing anecdotal evidence that supply chain is beginning to improve. We had the market PMIs last week, And I'm curious to see if the ISM manufacturing survey can support that as well. So that's what I'll be watching. Obviously, the jobs number is going to be the big focus on Friday.
Good deal. Tom, fixed income world, what do you expect?
I mean, I think that we probably could see some buying in fixed income as well, mostly on the fact that now the bond market is down about 50% more than the stock market heading into today. So people who were previously overweight bonds are probably going to be pretty underweight bonds. In terms of what we're seeing in the actual bond market, I mean, we're just so insanely flat right now. The 5-30 spreads, the difference between how much you get paid for a 5-year bond and a 30-year bond is only different by about 3 basis points right now. So very unusually flat curve. So there is going to be a lot of buying. I would expect it to be on the short end would be my expectation. Because why would you lock in for 30 years at 2.5% where you can buy for 5 years and get the same return? But it's just such an unusual market. So we'll see how the jobs reports look. If it starts to look a little bit weaker, as a result of the Fed potentially getting a little more hawkish, that could, move the bond market one way or the other, depending on how it's interpreted. But right now, everything's on sale. So people who are underweight, we're going to be padding those bond portfolios pretty heavily going into the end of this week. Just make sure we're buying, the best available bonds and trying to reduce some of the volatility that we're seeing there.
Awesome. Thanks, Tom. Thanks, Ben. We'll wrap it up there. We'll be back tomorrow morning at 8:30, and we'll talk to you guys soon.